Securities Markets Foundation Part 5. Debt Securities, Features, Types and Risks. This section explores debt capital, detailing the features of debt instruments, common types of debt securities, and the specific risks and returns for debt investors. Characteristics of debt capital. Debt capital represents money provided by lenders to the issuing entity, the borrower. Fixed return and tenor. Lenders expect regular compensation in the form of a pre-specified fixed rate of interest, coupon. The original amount, principal, is returned after an agreed tenor, maturity period. Once repaid, the security is extinguished. Priority of claim. Interest payments are a legal obligation of the issuer and are paid before taxes and before any distribution to equity investors. In case of business failure, lenders receive settlement before other stakeholders. Security, collateral. Lenders often seek security in the form of a mortgage or charge on the business's assets. These are called secured borrowings. Credit rating. Lenders rely on credit rating agencies to evaluate the issuer's ability to meet its debt obligations, i.e., its credit default risk. Types and structures of debt instruments. Debt instruments are commonly called debentures, for corporate sector, or bonds, for government public sector organizations. Plain vanilla bond. The simplest form, paying a fixed rate periodically and returning the principal at maturity at face value, par. Zero coupon bond. Does not pay periodic coupons. It is issued at a discount to the face value and redeemed at face value. The effective interest is the difference between the face value and the issue price. Floating rate bond. The interest rate is not fixed but is reset periodically with reference to a predetermined benchmark rate, e.g., MIBOR. Bonds with options. Callable bonds allow the issuer to redeem the bond early, typically if interest rates fall. Puttable bonds give the investor the right to demand early redemption, typically if interest rates rise. Short-term money market securities. The money market deals with debt for short periods, up to 1 year. Treasury bills, T-bills. Short-term debt issued by the central government, 91, 182, or 364 days maturity, carrying no default risk. Commercial papers, CPs. Unsecured short-term loans issued by companies and institutions, typically for working capital needs. Certificates of deposits, CDS. Short-term negotiable deposits issued by banks. Repos, reverse repos. Transactions where one participant borrows money against the collateral of eligible securities. Risks and returns of debt investing. The return on a debt investment combines coupon income and any price appreciation depreciation. The overall return is captured by the yield to maturity, YTM, which has an inverse relationship with price. Default credit risk. The risk that the issuer may fail to pay interest or principal on time. This is lower for secured debt and zero for government securities. Inflation purchasing power risk. Since coupons are fixed, high inflation erodes the real return, purchasing power, of the fixed income. Reinvestment risk. The risk that periodic coupon payments cannot be reinvested at the same or higher rate. Liquidity risk. Most corporate bonds trade infrequently, making it difficult for investors, especially small ones, to exit before maturity.